Hello, welcome again. So I wanted to record this short video for you as I promised to help you understand the rule of debit and credit a little bit better. Okay, I know the last time we didn't have a lot of time doing the 1 hour chat to go over everything, so I prepared this short video for you. Hopefully you will find it helpful. Okay, let's dive into it. Let's go back to the accounting equation. Okay, the accounting equation states the total asset must be equal to the sum of liabilities and owner's equity. Okay, for instance, if you have total asset of $1,000, okay, and you have a liability of $200, therefore, what is your equity total? 800. Because the sum of 200 and 800 is 1000. That must be equal to your total assets. Okay, now let's look at this from a T account perspective. When I say T account, and if you look at this, it definitely looks like a T. A T account basically looks like this. When you look at a T account, you see on the left side you have debit, and on the right side you have credit, and that's for all types of accounts. Now, what does a debit mean for an asset, and what does a debit mean for a liability and owner's equity? That's what we're going to look at now. Now, for asset account, a debit is an increase and a credit is a decrease. For liabilities and owner's equity, a debit is a decrease and a credit is an increase. Okay, and if you look at on this side that increase the account, you see why it says normal, because the side that increase the account is its normal balance. Okay, that means if you have a negative balance on an asset account, there is something wrong. Either you recorded some transaction incorrectly, okay, or you may have, in the case of cash, for instance, you may have overdrawn on your cash account. Okay, liabilities, the normal balance is a credit. So you would always want to see a credit balance in a liability account. Same for equity. You don't ever want to see a debit balance in your equity account. Okay, think of the equity account just like your checking account. Okay, do you ever want to see a debit balance in your checking account? If there's a mistake at your bank, for instance, and you call the bank and they took out too much money from your account, what do you call them and say? Do you call them and say, can you debit my account back? No, can you credit my account? Therefore, can you increase my account? Okay, hopefully this helped, but let me show you the next slide, which I think will be very helpful. Okay, so this one, I actually group these accounts in two different categories for you. If you look at the blue account, join expenses and assets, they increase with a debit, therefore their normal balance is a debit. That would be joint accounts. That's when you go to your bank and you withdraw money. Expenses, that's when you basically go to your, you pay your utility, your rent, your salary. Asset, that's what you own as a business. Where liabilities, equity, and revenue, these accounts increase with a credit. Therefore, their normal balance is a credit. So, if you look at this closely, you will see the word dealer. Okay, dealer. So if you can remember the word dealer, D-E-A-L-E-R. So the first three letters represent accounts that increase with a debit, and the last three letters represent accounts that increase with a credit. Okay, so that's it. Hopefully you find it helpful. If you do have any questions, please do not hesitate to reach out. Send me a text or a note, or send me an email. All right. And lastly, let's take a look at what some asset accounts and liability and equity accounts looks like. Asset accounts, we have, for instance, cash. We have land. Accounts receivable. Remember what account receivable is? That's when you made a sale on account, or you provided some service on account. You bill somebody and they're gonna pay you later. That's an accounts receivable. Notes receivable, same thing. Prepaid account, supplies, equipment, building. All these are asset accounts. That's what you own as a business. Liability account, That's basically where you have to pay somebody. These are obligations that you have to pay, right? Accounts payable. When you purchase something from somebody and they basically bill you, they send you a bill. Accrued liabilities, expenses that you incurred but you have not paid yet. These are accrued liabilities. Notes payable, again, a more formal type of accounts payable. Unearned revenue, we talked about that, but that's when you basically collected someone's money and you have not provided any work yet. But when you do provide the work, that unearned revenue become revenue. All right. What about this one? Equity account. These are your equity accounts, and therefore that's what your owner's equity will fall on. Owner's capital, okay, revenue, owner's withdrawals and expenses. These are types of equity accounts. As you can see here, you can see the sign plus for owner's capital and revenue. That means these have a positive impact on owner's equity. They increase their owner's equity. Withdrawals and expenses, they decrease owner's equity. What happens when you pay expenses? You basically write a check, your bank balance decreases, right? Therefore, your owner's equity goes down. Owner's withdrawal, when you withdraw money from your checking account, that means your bank balance is decreased. That's the same impact we're looking at here. Okay, so hopefully you find it helpful. Again, if you have any questions whatsoever, we can talk about it in the next class, or you can email me or send me a CTU messenger and let me know what questions you have about it, and I will do my best to help you understand it. All right, I will see you in class.